Have you ever opened your bank account and quietly wondered if you somehow signed up for a subscription called Broke Life Premium without realizing it? You work hard every day. You try to be responsible with your money. You're not out here living some extravagant lifestyle, and yet somehow your savings barely move. The idea of reaching $100,000 feels distant, almost unrealistic, like something reserved for people who were born into wealth or got lucky on a risky investment at the perfect time. But here's the truth most people never hear. You're not bad with money. You're not lazy. And you're definitely not incapable of building wealth. You've just been playing a game without knowing the actual rules. Because building your first $100,000 isn't about extreme discipline or cutting every small pleasure out of your life. It's about understanding how money actually works, and more importantly, how to make it work for you. Once you see that clearly, everything starts to change. Most people think of $100,000 as just a financial milestone, a nice, round number that feels impressive but ultimately arbitrary. In reality, it's something much more powerful. It's the point where your money starts to work for you in a meaningful way. In the early stages, progress feels painfully slow. When you have $1,000 invested, even a strong return barely moves the needle. At $10,000, you might start to see some growth, but it still feels small compared to the effort you're putting in. But once you reach $100,000, something shifts. At an average annual return of around 10%, your money is now generating $10,000 a year. That's no longer pocket change. That's real, noticeable progress, money being created without you trading your time for it. This is why Charlie Munger famously said that the first $100,000 is the hardest. Not because the number itself is magical, but because everything before that point depends almost entirely on your own effort, your income, your discipline, and your decisions. You are the engine. But after that, your money becomes the engine. And once that engine starts running, it doesn't just move, it accelerates. Imagine trying to fill a bucket with water. You pour steadily, you stay consistent, you even work harder to pour faster, but no matter how much effort you put in, the water level never seems to rise. Why? Because the bucket has holes in it. This is exactly how most people manage their money. They focus on earning more. They try to save when they can. They make occasional good financial decisions. But underneath all of that, their system is broken. Money flows in, and then quietly leaks out through inefficient spending, poor structure, and a lack of intentional strategy. So even when they do everything right, they still feel stuck. The issue isn't effort, it's not motivation, and it's definitely not intelligence. The issue is that they're trying to build wealth without fixing the system that holds their money in place. Because without a solid system, income alone doesn't create wealth. It just creates motion without progress. And until you plug those leaks, no amount of extra income will solve the problem. You'll simply earn more and lose more at the same time. One of the most common pieces of financial advice you'll hear is this: cut out your daily coffee. Stop buying small luxuries. Watch every little expense. And while those habits aren't necessarily bad, they miss the bigger picture entirely. Because the truth is, small expenses are not what's keeping most people from reaching $100,000. You're not falling behind because of a $5 coffee. You're falling behind because your housing costs might be eating up 40–60% of your income. Your taxes are higher than they need to be. Your investments, if you even have them, may be inefficient or inconsistent. Focusing only on small savings is like trying to drain a flooded room with a teaspoon, while ignoring the broken pipe pouring water in. It feels productive, but it doesn't actually solve the problem. Wealthy individuals understand something fundamentally different. They don't obsess over minor expenses. They focus on high-impact decisions, the ones that can change their financial trajectory in a significant way. They optimize the big levers: income, housing, taxes, and investments. Because one smart decision in those areas can outweigh hundreds of small sacrifices. And once you shift your focus from cutting small costs to optimizing big systems, everything becomes more efficient and far more powerful. Now that you understand the real problem and where most people go wrong, it's time to look at what actually works. Building your first $100,000 isn't about one lucky break or a single perfect decision. It's about combining a set of smart, consistent strategies that work together over time. Think of this as a system, not a checklist. Each piece strengthens the others. Each decision compounds on the next. And when implemented correctly, this system can dramatically accelerate your path to six figures. We're going to break it down into 9 key strategies. Some of them may sound familiar at first. Others might challenge what you've always believed about money. But the difference here is not just in knowing them, it's in understanding how they fit together and why they matter. Because when you apply them as a system, something powerful happens. You stop relying on motivation. You stop guessing. And you start building wealth in a way that becomes predictable. Let's begin with the first strategy. When people think about building wealth, they usually focus on earning more or investing better. But they often overlook one of the biggest financial levers available to them: taxes. For most individuals, taxes are one of the largest expenses they will ever pay, often comparable to housing or transportation over a lifetime. Yet, unlike other expenses, very few people take the time to understand how to legally reduce them. Instead, they simply accept taxes as fixed and unavoidable. But that's not entirely true. There are systems in place, designed by governments, that actually encourage you to invest and save by offering tax advantages. These aren't loopholes or tricks. They are intentional incentives meant to reward long-term financial behavior. When you use tax-advantaged accounts, you're not just investing, you're effectively getting an immediate return. For example, when you contribute to certain retirement accounts, you reduce your taxable income. That means a portion of the money that would have gone to taxes now stays in your control, working and compounding over time. In simple terms, you're keeping more of what you earn, and you're putting it to work sooner. That combination is incredibly powerful, because every dollar you don't lose to taxes is a dollar that can grow for years, sometimes decades. And yet most people ignore this completely. They spend hours trying to save a few dollars on daily expenses, while leaving hundreds or even thousands on the table every year in tax inefficiencies. If your goal is to reach $100,000 faster, you can't afford to overlook this. Optimizing taxes isn't optional. It's a foundational part of the system. If your employer offers a matching contribution to your retirement account, and you're not taking full advantage of it, you are quite literally leaving money on the table. This is one of the rare opportunities in finance where you are guaranteed an immediate return. No risk, no waiting, no uncertainty. Here's how it works. Many employers will match a percentage of what you contribute to your retirement plan, up to a certain limit. For example, they might offer a 50% match on contributions up to 6% of your salary. So if you earn $50,000 per year and contribute $3,000, your employer might add an additional $1,500. That's a 50% return on your money instantly. No stock market, no timing, no strategy, just participation. And yet, millions of people fail to take full advantage of this benefit. Some believe they can't afford to contribute. Others simply don't prioritize it. But in reality, choosing not to use employer matching is like turning down a guaranteed raise. Imagine your boss offering to increase your salary, and you saying no. That's exactly what's happening here. Even if your financial situation feels tight, starting small is better than doing nothing. Contribute enough to get the full match if possible. That should be your baseline. Because before you look for high-return investments or complex strategies, you should first capture the easiest win available. And this is it. Most financial advice tells you to live below your means. And while that's not wrong, it often gets interpreted in a very limiting way. Cut more, spend less, sacrifice more comfort. But there's another approach that is far more powerful. Instead of shrinking your life, expand your income. Relying on a single source of income puts a ceiling on how fast you can build wealth. No matter how disciplined you are, there's only so much you can save from one paycheck. That's why creating additional income streams becomes a game changer. This doesn't mean working yourself into exhaustion or taking on endless extra hours at your current job. It means building new sources of income that exist outside your primary salary. This could include freelancing in a skill you already have, starting a small online business, offering services in your spare time, or building something that generates income independently over time. But the most important part isn't just earning more. It's how you treat that extra income. Instead of letting it blend into your regular spending, you assign it a specific purpose. Building wealth. Your primary income covers your lifestyle. Your additional income builds your future. That separation changes everything psychologically. Because you no longer feel like you're sacrificing your current life to save more. You're simply directing new money toward long-term growth. And over time, that extra stream, no matter how small it starts, can dramatically accelerate your journey to $100,000. When people first start investing, receiving dividends feels exciting. It's proof that your money is working. It feels like passive income, like you're getting paid just for owning assets. And naturally, there's a temptation to spend that money. It feels like a reward. But this is where a critical decision appears. You can either treat dividends as income or as fuel. Because the real power of dividends isn't in what they give you today, it's in what they can build for you tomorrow. When you reinvest your dividends, you use them to buy more shares. Those additional shares then generate their own dividends, and those dividends can be reinvested again. This creates a cycle, a loop that keeps feeding itself. Over time, that loop turns into a compounding engine, one that grows faster and faster without requiring additional effort from you. Historically, a significant portion of long-term market returns has come from reinvested dividends. Investors who consistently reinvest tend to see substantially higher growth compared to those who withdraw and spend that income early. The difference may seem small at first, but over years, especially decades, it becomes massive. This strategy requires patience. It asks you to delay gratification in exchange for exponential growth. But if your goal is to reach your first $100,000 faster, this is one of the simplest and most effective ways to accelerate the process. Instead of consuming what your investments produce, you let them multiply. Investment fees are one of the most underestimated threats to long-term wealth. They don't feel painful. They don't show up as a big, obvious expense. And because of that, most people ignore them completely. But that's exactly what makes them dangerous. Fees operate quietly in the background, taking a small percentage of your portfolio every single year. On the surface, a 1% fee doesn't seem like a big deal. It feels insignificant, almost negligible. But over time it compounds. and not in your favor. Because while your investments are trying to grow, fees are consistently pulling money out. Year after year, that small percentage reduces your total returns, slows your compounding, and ultimately shrinks the size of your portfolio. The long-term impact is enormous. Over decades, the difference between a high-fee investment and a low-fee one can amount to tens or even hundreds of thousands of dollars lost, not because of bad investing decisions, but simply because of unnecessary costs. The good news is that this is one of the easiest problems to fix. Today, there are many low-cost investment options available, especially broad market index funds, that provide strong performance without excessive fees. These options allow you to keep more of your returns working for you instead of being siphoned away. Think of it this way. Every dollar you don't pay in fees is a dollar that stays invested. And every invested dollar continues to grow over time. Minimizing fees may not feel exciting, but it is one of the most reliable ways to accelerate your journey to $100,000 simply by keeping more of what you already have. One of the biggest mistakes investors make, especially in the early stages, is believing they can outsmart the market. It's an appealing idea. Buy when prices are low. Sell when prices are high. Avoid downturns. Maximize gains. In theory, it sounds simple. In reality, it almost never works. Because timing the market requires you to make two perfect decisions: when to get out and when to get back in. And even professional investors struggle to do this consistently. For most people, the pattern looks like this. The market drops, fear takes over. They sell to protect their money. Then the market recovers, confidence returns. They buy back in at higher prices. They end up doing the exact opposite of what they intended. The problem is emotional, not intellectual. When markets fall, uncertainty rises. News headlines amplify fear. It feels safer to step away. But historically, some of the market's best days occur shortly after its worst days. If you miss those key moments, even just a handful over many years, your overall returns can be dramatically reduced. That's the hidden cost of trying to be smart. The alternative is far simpler and far more effective. Invest consistently. Stay invested. Ignore short-term noise. Let the market do what it has historically done over time: grow. This approach may feel less exciting. It doesn't give you the thrill of making bold moves or predicting outcomes. But it works. And when your goal is reaching your first $100,000, consistency will outperform cleverness every single time. When people begin investing, they often fall into one of two extremes. Some overcomplicate everything. They spend hours researching individual stocks, analyzing charts, following news, and trying to predict which company will become the next big winner. Their portfolio ends up scattered, inconsistent, and heavily dependent on luck. Others do the opposite. They don't think about investing at all. They leave their money sitting in a savings account, earning almost nothing, slowly losing value to inflation. Both approaches lead to the same outcome: missed opportunity. The truth is, building wealth, especially in the early stages, is not about hitting home runs. It's about steady, reliable progress. Instead of trying to guess which company will outperform, a far more effective strategy is to own a piece of the entire market. This is where broad market index funds come in. By investing in something like an S&P 500 index fund, you gain exposure to hundreds of the largest and most successful companies. You're not betting on a single winner. You're participating in the overall growth of the economy. Companies rise and fall, industries shift, but over time, the market as a whole has historically moved upward. This approach removes the need for constant decision-making. You don't have to predict trends, analyze earnings reports, or react to every piece of news. You simply invest and stay invested. It's not flashy, it won't make headlines, but it is one of the most proven ways to build wealth consistently. And when your goal is reaching $100,000, simplicity is not a weakness, it's an advantage. As your income grows, your lifestyle will try to grow with it. At first, it feels justified. You get a raise, you upgrade your apartment. You earn more, you buy a nicer car. You start doing well, you spend a little more to reward yourself. Individually, each decision seems reasonable. But over time, they add up. And before you realize it, something strange happens. You're earning significantly more than you did a few years ago. But you still feel financially stuck. You're still living paycheck to paycheck. This is lifestyle inflation. It's one of the most dangerous traps in personal finance because it doesn't feel like a mistake. In fact, it often feels like progress. You're improving your quality of life, upgrading your environment, and enjoying the results of your hard work. But behind the scenes, your ability to build wealth is being quietly eroded. Because every increase in income is being matched, or even exceeded, by an increase in spending. The people who build real wealth approach this differently. They don't base their lifestyle on what they currently earn. They base it on what they actually need and what aligns with their long-term goals. When their income increases, they don't automatically upgrade everything around them. Instead, they make a conscious decision. How much of this increase will improve my life today? And how much will secure my future? Even redirecting a portion, half, or even less, of each raise into investments can create a powerful compounding effect over time. Because while lifestyle upgrades provide temporary satisfaction, investments create permanent leverage. And the sooner you learn to control lifestyle inflation, the faster you move toward your first $100,000. When it comes to building wealth quickly, no single decision has more impact than your housing cost. It is, for most people, the largest monthly expense by far. Rent or mortgage, utilities, insurance, maintenance. When combined, housing can easily consume 40%, 50%, or even 60% of your income. At that level, it becomes extremely difficult to build momentum. You're not just living, you're working primarily to maintain your living situation. And here's the uncomfortable truth. If too much of your income is locked into housing, reaching your first $100,000 will take significantly longer, no matter how disciplined you are in other areas. But unlike many expenses, housing is more flexible than people think. It may feel fixed, but in reality, it's often a reflection of choices rather than necessities. Optimizing your housing doesn't mean living in poor conditions or sacrificing your well-being. It means being strategic, especially during the phase when you're trying to build your financial foundation. That could look like living with roommates to split costs, moving to a more affordable area, choosing a smaller or more efficient space, or exploring creative strategies like renting out part of your home. Even a moderate reduction can create a massive impact. For example, reducing your housing cost by $800 per month frees up nearly $10,000 per year. Invested consistently, that difference alone can grow into hundreds of thousands of dollars over time. Few financial decisions offer that level of leverage. And the most important part is this: it doesn't have to be permanent. You're not committing to a lifetime of sacrifice. You're making a temporary, strategic adjustment that allows you to build a strong financial base, one that will later give you the freedom to live however and wherever you choose. In the journey to your first $100,000, this is the most powerful move you can make. Each of the strategies you've just seen is powerful on its own. But the real transformation happens when you combine them. Because wealth is not built through isolated actions. It's built through systems. When you optimize your taxes, you keep more of your income. When you capture employer matching, you add instant returns. When you create additional income streams, you increase your capacity to invest. When you reinvest dividends, you accelerate compounding. When you minimize fees, you preserve your growth. When you avoid market timing, you eliminate costly mistakes. When you invest in simple, broad markets, you ensure consistent progress. When you control lifestyle inflation, you maintain a high savings rate. And when you optimize housing, you unlock the largest source of investable capital. Individually, each move pushes you forward. Together, they create momentum. And that momentum changes everything. Because once your system is in place, you no longer rely on motivation or willpower. You don't have to constantly make perfect decisions. The structure itself begins to carry you forward, even during times when life gets busy or unpredictable. Your finances shift from reactive to automatic. And that's when progress becomes consistent. Before $100,000, building wealth often feels like pushing a heavy object uphill. Every dollar requires effort. Every gain feels small. Progress can seem slow and frustrating. But once you reach that first six-figure milestone, the experience begins to change. The effort doesn't disappear, but the results become more visible. Your investments start generating meaningful returns. Growth becomes easier to notice, and instead of feeling like you're constantly forcing progress, it begins to feel like momentum is working with you. You're no longer pushing the system. You're riding it. And that psychological shift is just as important as the financial one. Because when you see your money growing in a tangible way, it reinforces your behavior. It makes consistency easier. It makes patience more natural. Wealth building stops feeling like a sacrifice and starts feeling like progress. Most people will continue down the same path. They'll earn, spend, repeat. They'll hope things improve over time. They'll wait for the right moment to take control of their finances. But that moment rarely comes. Not because it doesn't exist, but because it requires a decision. You now understand the principles. You've seen the system. You know what actually makes a difference. So the question is no longer what to do. The question is, will you act on it? Because every dollar you save and invest today is more than just money. It's a step toward freedom, a step toward security, a step toward having options in the future that most people never get. Your future self is shaped by the decisions you make right now. And the path to your first $100,000 is no longer a mystery. It's a choice.